Okay, so for the fourth question, which is P8-23A, consolidation worksheet year of retirement using straight line method. So Tyler Manufacturing purchased 60% of the ownership of Brown Corporation stock on January 1st, 2000 X1 at underlying book value. At that date, the fair value of NCI was equal to 40%. Tyler also purchased 50,000 of Brown bonds at par value on December 31st, 2000 X3. So bonds sold the bonds on January 1st, 2000 X1 at 120. They have stated interest rate of 12%. Interest is paid semi-annually on June 30th and December 31st. Assume Tyler uses the fully adjusted equity method. On December 31st, 2000 X1, Brown sold a building with a remaining life of 15 years to Tyler for $30,000. So Brown had purchased the building 10 years earlier for $40,000. It is being depreciated based on 25-year expected life. So we are given the trial balance at December 31st, 2000 X3. So we are asked to prepare a consolidation worksheet and consolidated financial statements in 2000 X3. So there are two intercompany transactions, which is the first one is about the bonds. The second one is about the transfer of building. Okay, so we will do it one by one. We start it with the bonds first. So we can see that Tyler purchased 50,000 of Brown bonds at par value on December 31st, 2003. So pay attention to Brown's bonds payable is 200,000. Okay, so 50,000 from 200,000, it is only 25,000. So in order to calculate the gain or loss on constructive retirement, we need to determine first how many percent that Tyler has purchased, and now we have revealed that it is 25%, so that we can calculate the premium also. Okay, so the premium, it is 25% of 28,000. Okay, so 7,000. Okay, so we can now calculate the gain on constructive retirement. So why is it directly the pro rata premium on bonds payable? Because notice that Tyler also purchased of Brown bonds at par value. So basically, if there is no premium or discount, there is no gain or loss on the constructive retirement. But now, because we know that there is a bond premium, and premium will usually add the gain in constructive retirement, so that we can directly take the 7,000 from the premium on bonds payable. Okay, so 7,000 will be the gain. And then we have done for the bonds, we can directly go to the buildings, okay, or intercompany transfer of asset. So like the way you do from the last chapter assignment, first we calculate how much is the depreciation originally recorded by Brown. So Brown purchased at 40,000 and the useful life is 25 years. So depreciation recorded by Brown is 1,600 per year. Okay, and at the date of sale, it has been for 10 years the depreciation. So 1,600 times 10, it will become 16,000. So the book value will be 24,000 at the date of sale. So Brown sold the building for 30,000, and then the book value is 24,000. So we have a gain of 6,000. And then how much is the depreciation recorded by Tyler is 30,000 divided by 15 years left, so 2,000. Okay, so the difference, this will be the extra depreciation. Okay, after that we can go to the basic elimination entry. So basically you just do the elimination entry like the way you do usually. Okay, debit common stock, debit retained earnings. Okay, income from Brown. Okay, you can directly take it from here. Okay, so basically you just take sales minus the expenses, okay, and then please remember that you have to reverse the gain from the sale of the equipment, because this is the second year already, so you can reverse twice already, okay. So and then you need to add the gain, okay, 7,000, all of it, because this is the year of the retirement, okay. And then for the investment also, okay, so basically it is just 60% of the common stock and retained earnings, and then you plus the net income minus the dividends, and then remember to plus the 60% of the reverse gain, reverse of the gain from the building. So because this is upstream, so you need 2 times 60%, okay, and then you add the gain on retirement. So this is upstream also, okay. So later you need to allocate the gain from retirement to the parent and the NCI also. And then after that you can go to the T accounts before you record the elimination entries for the transfer of fixed asset. Okay, so basically you just do T accounts for buildings equipment, accumulated depreciation and depreciation expense. So Tyler originally bought it at 30,000, meanwhile Brown originally bought it at 40,000. So in order to add 30,000 to 40,000, you need to add 10,000. And then the depreciation expense, so Tyler recorded 2,000, meanwhile Brown only recorded 1,600. So we need to minus 400 to make it into 1,600. And then for the accumulated depreciation for Brown, okay, so at the time of sale it is already 16,000, and then plus 2 years from 2000 x1 and to 2000 x3, okay, so plus 3,200, it will become 19,200. And then for Tyler, 1 year Tyler will record 2,000. It has been 2 years, so it is 4,000. And then remember to put the extra depreciation on the debit side, 400. So you will need to add 15,600 to get 19,200, and then you can do the elimination entry. So debit accumulated depreciation, credit depreciation expense 400 for the extra depreciation, and then debit depreciable assets 10,000, okay. Credit accumulated depreciation 15,600. So basically for this, because this is upstream, so you need to allocate to the parent and NCI, okay. So this is 5,600, you divide 60% to parent, 40% to NCI, and then we have to make the schedule for the bonds, okay. So because this is the year of the retirement, okay, so only the bonds payable, bonds premium, investment in Brown bonds, and then gain. So the bonds payable is from the Brown, we need to omit it or eliminate it. Bonds premium also, then investment in Brown bonds also, and then the gain we show it. Gain is not to eliminate, but we show it in the consolidated financial statements. So again, debit what you need, which is what is on credit, what is on debit, okay. Except the gain, because we need to show it, that's why we credit it. After that, we can do the worksheet. So basically, just move all of the data from the trial balance, okay, sales, interest expense, operating expense, okay. Before that, why there's no interest expense and interest income? Because it's already at the end of the year when Tyler purchased the bonds, okay. So just move, okay. Remember to put the gain on bond retirement, come from bond also. Then you move all the elimination entry related to income statement, okay, which is income, NCI and NI, depreciation expense, and gain. Okay, so you must show the gain here, yeah, and then income must be 0 like the way you do usually. Okay, so you will get the consolidated control interest net income, same with the Thailand manufacturing. Then the statement of retained earnings, okay, move again from the trial balance along with the dividends. Okay, net income is from the previous section. Okay, then you put the retained earnings on debit and dividends on credit. So if you get the same ending balance already, you can go to the balance sheet part. So move cash, accounts receivable, inventory, investment in brown bonds, investment in brown stock, depreciable assets net. Okay, then accounts payable, bonds premium, common stock, retained earnings, NCI and A. Okay, retained earnings is from the previous section, so make sure it's balanced first, and then you move the elimination entries. Okay, remember, investment in stock must be 0 and in bonds also. Okay, bonds premium left only the part that is not related to affiliate. Okay, and then if it's balanced already, then you can do B part, which is for the consolidated financial statements. So for the sake of easiness, then you can start from income statement, okay, just like the way we do usually, and then consolidated statement of retained earnings. Okay, just move of the numbers, then consolidated balance sheet.